Warren Buffett laid out a scenario in 1999, and he stated that the market runs in cycles. You have sometimes a bearish secular market, or a secular bear market, or a secular bull market. And this is what he coined in 1999, and this is what he talked about. The last time I tackled this subject in 1999, I broke down the previous 34 years into 2-year, 17-year periods, which in the sense of lean years and fat were astonishingly symmetrical. Here's the first period. As you can see, over the 17 years, the Dow gained exactly 1/10 of 1%. Dow Jones, you could see December 31st, 1964 of 874, and then December 31st, 1981, 875. And you could see that the market went nowhere in a 17-year span. What happened afterwards? December 31st, 1981, Dow 875, December 31st, 1998, 9,181. We know that the Dow actually plateaued around 11,700 in the year 2000. And Warren Buffett also analyzed the gain in the gross national product when the market stayed flat between 1964 and 1981, where the gain was 373%, and the gain from 1981 to 1988, 177%. So what was the explanation? He concluded that the market's contrasting moves were caused by extraordinary changes in two critical variables, and by a related psychological force that eventually came into play. And then he also talked about one thing, though: interest rates. So here's the record on interest rates at key dates in our 34-year span. They dramatically moved up. That was bad for investors in the first half of that period, and dramatically down, a boon for investors in the second half. You could see here that these are 3 times, and during that time we did see interest rates go up. I do remember reading about the 1980s, where interest rates just went up like crazy, and then eventually, when the economy started to get better, rates went down. So we're going to look at just a few charts regarding this secular bear market. Let's look at the 1960s, right? 1970s, 1980s, where we saw the secular bear market. And we could see that you had multiple times where you saw a huge correction to the downside, right? Dow 1000, or yeah, Dow Jones Industrial Average 1000. Then it went to 650, right? More than a 20% correction. Then you saw it go up, bull market from like 70 to 73-ish, Dow a little above 1000. Where did it go to then? It went to 600, or a little below that in 1974, 1975. Then you saw the Dow go right back up from 74 to like 76. And then you saw a sideways pattern until, not sideways pattern, but you saw, yeah, you could say it's sideways from 77 to 80. It ended with an inflationary spiral. And then we saw another correction, and then that's when that bull market occurred from 1982 to 2000 with Reagan and Clinton, with decent supply side measures, and also it was a more moderate government during that time frame. Now let's go to today. And we could see that there's a secular bull market that started in the year 2000. You saw a correction in 2002-ish, 2001, because of what happened with, not Enron, but 9/11 and the tech bubble bursting, and the economy did not slowly recover until 2003. Then you saw dead cat bounce until 2007. It was a recovery based on phoniness. And then all of a sudden, 2009, you see this generational low. And now we've seen the S&P off to the races. So if you just want to look at this chart again, I mean, you saw it peak over the trend line, and then you saw a huge crash. Not a crash, but a huge correction. Does it necessarily have to mean that we're going to see the same pattern? Not really. What this could mean is that there could be potentially a correction. I'm not saying there's going to be a guarantee. So listen to me carefully. That's why I tell you to go to your financial advisor if you're a newbie, or if you are an advanced investor, then just do your own due diligence. I can't tell you what to do. That's your choice. But these are my own thoughts, and the way that I look at it is that I see some sophisticated individuals who have newsletters and have actually had decent results. And I've understood that they are now leaving, or they've told their clients to leave. And if you see something like that, that's a red flag in my eyes. That doesn't necessarily mean that they're right, but it just makes me question the so-called rally right now, which I say is phony because that's based on central banking manipulation by keeping interest rates low. And now you have the yen carry trade, so people are going to try to find yield, and where they're going to invest. They're going to invest in the stock market. They're going to invest in, or they're going to sell bonds. And they're not going to look at gold and silver. I wish I knew that a few years back, what I do know now, but after going through one business cycle, you understand how these cycles operate, or you get a gist of what's going on. So if we see something similar to what happened in the 1970s, and if there is a secular bear market, as Warren Buffett alluded to in 1999, what's going to happen here? Could we see the Dow going, the S&P going to like 1100-ish, 1200-ish? I mean, it sounds crazy, or 1300-ish. We don't know what's going to exactly play out. But if we are in a secular bear market, as Warren Buffett says, then who knows? This thing may go down. And that's actually what's going on in my thought process right now. But you have to remember, the 1970s, that was a trading environment. So those individuals that are sophisticated, understand technical analysis, just understand, just even basic technical analysis, will probably do fine. It's just that the buying and holding at that point, or at this point, makes me a bit uneasy. And the reason why it makes me uneasy is because we've seen a huge move to the upside from 2009. So let's just look at this phases of a secular bear market. This is as of actually 2012. So we know that the S&P is much higher. So if you extrapolate the data, put it here, a little there, whatever it is. So if you look at it right now, we see that charts look similar. You see similar activity going on. You got the momentum trading, then defensive, that's the bear market, and then you have oversold stocks. That's when smart money started to come back in. And then you see another stage, mature bull, late bull. You see all this momentum, and then you see that crash in 2008, 2009. And then you see this pattern reverse again, with easy money leading the way in, relaxing the mark-to-market rules, which actually cause the market to go higher, because when the banks don't value their assets at fair market value, then you could book it at whatever the hell you want to. Mark-to-model accounting. So if you want to look at this, it's just looking eerily similar to 2000, 2007. I'm not guaranteeing anything once again. That's why do your own homework. Now we see secular bull markets and secular bear markets here. And we look at the fact that no market is similar. History doesn't repeat itself exactly, but you do see similar patterns. And we could see the secular bull markets, the Dow Jones Industrial Average inception to 1899, that was a bull market. Secular bear markets then started in 1899, September 1899 to August 1921. So that was over 20 years. And then the next bear market was from 29 to 42. February 1966 to 1982. So what does this mean here? I mean, one of the secular bear markets was 13 years. The other one was 22 years. And then from 1966 to August 1982, roughly 16, 17 years. What is going to be the case this time. January 2000 to when? Was it 2009 where it was the end of that secular bear market? I don't think so. I mean, a lot of people may be saying that, but if you want to look at it, you have all this margin debt outstanding. So if you have all this margin debt outstanding, eventually, in my opinion, the chickens will come home to roost, and we're going to see most likely a correction. Now, how steep the correction? Some traders that I've talked to that are sophisticated told me that it's going to be roughly 20 to 30% from the high. And they told me that the high would probably be around somewhere between 15,500 or 16,500-ish, around that frame. So if you see a correction from here, who knows, 12,000, 13,000 could be the bottom, and then you could see from 2,000 stocks 11,700, and then the Dow 13,000. Stocks went nowhere if that scenario holds up. So all I'm saying is that Warren Buffett, the guru, right, the sage out of Omaha, he stated that he sees a secular bull market for 17 years. And if everyone is bullish right now, that makes me wary. And that's why I just feel like trading stocks right now. I don't feel like taking a huge long position, just holding it for like 4 or 5 years until the next market cycle comes, because the market has moved up significantly since 2009. Anyways, guys, thanks for listening to me, and I'll talk to you another time, guys.